So I started to invest in the stock market less than 3 years ago at the age of 47. We now have multiple portfolios with double-digit returns growing every month. But we made some decisions at the beginning that literally saved us hundreds of thousands of dollars. But if you're starting to invest now in your 20s and 30s, the choices you make now could save you even more, perhaps millions of dollars. By the end of the video, you're going to know how we navigated this, the choices we made, and I'll even reveal my portfolios to you. Pretty proud of them. Okay, let's get into this. 3 years ago, we decided to invest in the stock market as part of our financial plan. As I said in previous videos, we're late starters to this. We have some catching up to do. So after some research, we understood the basics. Invest into stocks and shares of good performing companies and hold over the long term. This would eventually help our retirement plans, or could even be passed down as generational wealth. In our initial research, we came across ETFs in the stock market, and we decided these would be perfect for us. An ETF is an exchange-traded fund. It's essentially a basket of stocks and shares of good companies that's traded on the stock market. These baskets can hold hundreds, if not thousands of companies, providing you with an immediate, diverse portfolio. They also save a lot of time because the companies are chosen for you. You don't need to go over a profit sheet and pick the best ones. So armed with this information and feeling like we knew the basics, so we wouldn't embarrass ourselves, we booked ourselves with 3 local financial advisors. I thought if we could have an expert professional put together a fund for us and manage it, we could really maximize our returns. We also figured with their experience, they could beat the market, providing real value for money. After all, we were totally new to this. We didn't want to make any mistakes. Little did we know. So armed with our newly opened tax-free account and some cash we'd put aside, we went to see all 3 advisors. We sat down with each one and found out how they put the portfolio together, how they manage it, and of course, the charges. Once we had all the information together, we were able to go over it and digest it. And I've got to say, we were shocked. Our minds had completely changed, and we quickly had to come up with a plan B. If you found some value to this video today, like and subscribe below. Together we can make smarter money choices. From our initial research, we chose 4 ETFs that we were interested in. The 4 funds together will give us a nice diverse portfolio. They had the best performing companies from various fields. So the 4 ETFs that we had chosen were the Vanguard VOO, Vanguard VGT, the iShares Core World, and the Charles Schwab REIT ETF. All 4 were tested over time with great success, and between the 4 of them, we could look forward to 12% return. For us, it seemed like a great portfolio. However, all 3 financial advisors dismissed our suggestions for their own ones. But when we checked further, we realized all 3 funds would return an average of 7%. Even worse, the exchange rate for the portfolios were much higher than the ones that we had chosen. The exchange ratio is simply the cost of holding the ETF by the company. In the case of the VOO ETF, Vanguard would charge us 0.03% to hold the ETF. In fact, the exchange ratio for holding all 4 of our ETFs in our portfolio was only 0.07%. Very acceptable, at very low cost. However, for the financial advisors, the lowest cost exchange ratio was 0.7%, 10 times higher. So for every $1,000 we invested with the financial advisors, we will be paying a minimum of $70. This seemed high. The exchange ratio on our portfolio was $7 per $1,000. And on the financial advisors, it was $70 per $1,000. A 10 times difference. This doesn't seem too bad until your fund starts growing. For example, if you invested $300,000, you would be charged $2,100 with the financial advisors. With our own little fund, it was only $210. And of course, as your fund grows, your annual charge grows. But this is just the beginning. It gets much worse. Most financial advisors would charge you around 1% to manage your portfolio. It's the assets under management fee. 1% doesn't sound like a lot, but just like your returns on your portfolio, it grows and compounds over time in a big way that we never expected. Using this compound interest chart from Wiki Boggleheads, I'll show you what I mean. A 1% fee over 20 years will cost you 18% of your returns. So if you invested $300,000 at 10% average return each year, after 20 years you would have $542,000 approximately. You will be paying almost $50,000 or a fifth of your returns in the assets under management fee. Over a 40-year period, you would lose almost a third of all your returns to the asset under management fee. We were flabbergasted. It was astronomical. If you invested consistently over 40 years into good ETFs and companies, you should expect a portfolio of anywhere between $3 and $5 million. This is largely from compound interest over time, but realizing losing a third of that really put it in perspective for me. Quite honestly, it made my eyes water. And remember, this figure is added to the exchange ratio that we talked about previously. But don't take my word for it, do your own research. Your own due diligence is an important step in your financial plan. Only once you've done that and you feel confident, should you make a decision. Now, I don't want to take away from the professional service that financial advisors provide. They can also help you with other areas of your financial plan, like tax strategies and other wealth management services. But the huge compounding costs over time and the low return on their portfolio really made the decision for us. And just to be sure, we did some research online too. On average, almost 9 out of 10 actively managed funds, similar to the ones that we were presented with, failed to beat the market. According to the 2020 Spiver report, most of these had poor performance and high fees. It was just the thing that we were experiencing. This was not the path for us. We would be paying hundreds of thousands of dollars of fees over time, and if our portfolio continued to grow, it could be up to $1 million in fees. So suffice to say, we parted ways with the financial advisors and decided to do it by ourselves. By investing into ETFs, we felt confident with the diverse nature of them, and they have been proven over time. As we all know, there are ups and downs in the stock market, and nothing can be taken for granted, but these funds had proved themselves year after year, so we felt confident with that. And considering these funds individually had billions in holdings, we would be part of a large community of investors. With their low expense ratio and the hand-picked good stocks, it was a set and forget strategy. We would just dollar cost average each month on an auto payment. It was perfect for us and perfect for our busy lives. Remember, investing in the stock market was an important part of our financial plan, but not the main focus. It happily grows and compounds for our family, or we continue with our lives. In fact, we felt we did so well, since then we've put together a dividend portfolio. So in Canada we have a tax-free savings account, a TFSA, and this account is magical. All the returns you get in this account is tax-free, every single dollar. Two of the dividend stocks we have in there is Enbridge and TD Bank. Every quarter they put dividends in there, which we reinvest and buy more stock. It will purchase more stock with the profits automatically, and over time it will grow in the background. This also adds a bit of a diversification for our portfolio, because as the stock market goes down, dividend stocks are typically very stable. Over time, as our confidence has grown, we've purchased more stock and created other portfolios. But that's another video. For now, you get an idea of what we did and why we did it. Knowing we wanted to invest in the stock market for our family's security and actually doing it, in the end, ended up being poles apart. We had to research and investigate and avoid all the rabbit holes that popped up. There are a lot. Concluding we didn't have to pick up individual stocks and actually focus in on 2 to 5 ETFs was a game changer for us. We get all the diversification and proven history that we were looking for, and in one neat basket. We didn't have to learn to pick good companies, and we didn't have to look at a profit sheet. Vanguard and the other companies had done that for us for a very small fee, and we were happy to pay it. And now our funds do double-digit returns and have the magic of compound interest. We're very happy with our choices, and we continue to dollar cost average into them each month. This is just part of our financial plan, but it's a very key one. And once we realized the ETFs could do all the heavy lifting for us, it was an easy choice to make. But what are your experiences with financial advisors? Perhaps we were just unlucky in this case. And if you manage your own funds, tell us about it below. Subscribe for smart money choices and wealth building simplified.